Welcome to ABU Group show here today. I'm excited to have some fun topics today with my friend Trent Lee, who's a business broker and a business valuation expert.
Yes.
Welcome.
Yeah, thanks for having me.
Absolutely. Well, first, tell us a little bit about your life and background in this role.
Yeah, so actually born and raised here in Vegas. So I came from a entrepreneurial family. So I've seen the highs and the lows, and I saw my dad go through selling a business. He had a business here in town growing up, depending on the time of year, between 600 and 800 employees. I saw him get an offer. At the time, I didn't know it was a private equity group. So I saw him go through that. I kind of same general, interest, and had a couple businesses myself and sold, not nearly as big. I had one, I grew to about 90 employees and sold it in 2024. Had another one they exited from. And at that point, I'd seen enough, having seen friends, family sell their business, gone through it myself a couple of times, that I had worked with a number of business brokers along that process, CPAs, attorneys, escrow services, all the kind of the mixture in there, and honestly was not really that impressed with the people I saw when it came to the business broker community. And I thought, you know what, given my background, my experience, I think I can do a better job.
Let's raise the bar.
Yeah, so that's what got me into it. Yeah.
Thank you for sharing that.
Yeah.
What do you love most about helping people sell versus helping people buy businesses?
I love the day-to-day being so different. Like I had mentioned, I'm fairly entrepreneurial. I usually, after 2 or 3 or 4 years, would get bored with whatever I was doing, and I'd start itching to start something on the side or a different business. And I haven't gotten bored since I got into the industry, largely because it's so different. One day I'm in a little dinky small mom and pop pizzeria. The next one I'm in a fabrication, company, manufacturing, whatever it happens to be. And so it's so unique and it's so different.
So you like variety, maybe get a little, attention deficit, right?
Yeah.
And I can relate to that. That's one of the things I like about my world too, is variety in the people.
Mm-hmm.
So let's talk about, kind of jump into the business aspect. I know, I talk to a lot of business owners who are starting to think more and more about selling. What are some of the biggest levers that make an impact on businesses selling for what people hope for or ideal values?
Yeah. So as much as I would like to tell you a business owner can sell it for exactly what they want, exactly what they need for retirement, valuations just don't work that way.
Sure.
Sometimes I'll meet business owners and they're like, I want to sell my business for whatever, $5 million. And I'll ask them, okay, well, let's walk through it. How'd you get to that price? We got to justify that price. Well, that's what I need to retire. That doesn't work. Valuations aren't based on what you need.
People don't want to buy based on that, right?
Yeah, but there are some really good things that you can do to prepare for and plan for and try and maximize that valuation. First and foremost, you have to know your numbers. That's what valuations are largely based off of, is the adjusted earnings, the adjusted EBITDA figure, what some different figure, seller's discretionary earnings. So we're looking at both SDE, seller's discretionary earnings, adjusted EBITDA figure. And I'm surprised, and it's the same thing when I watch Shark Tank, the show. Some of these guys show up on the show and they don't know their numbers.
They don't even know what their EBITDA is.
Yeah, and I'm like, you guys know Kevin O'Leary. You know what he's going to ask. You've seen the show. Why? How can you possibly show up to the show not knowing your numbers? Granted, I'm not, these guys aren't auditioning for a show that I'm talking about, but I'm often surprised how many of them run their business without really knowing their business, the numbers of the business. And so, just yesterday I was with someone, and they just have no real concept for how much profitability, what the profit is left over annually, let alone month over month. And so right off of right out of the gate, I'm really stuck. I can't do much until I get their tax returns and their financials. Even, when I first meet with them, I'm just having a high level conversation. So we can't really dive in too much because the core foundation of what our discussion is going to be is how profitable are they? That to a large degree, at least for Main Street businesses, Main Street deals, the profitability determines the valuation. The other aspect is we could look at asset value, but no one wants to sell their business for asset value. They want a multiple of earnings, what's called a going concern valuation, based on the profitability, the historical profit. So knowing their numbers is first and foremost. Making a business that's not overly dependent on them,
on the owner,
is really vital, and that honestly is a skill set. Someone might be great at cleaning carpets, and so they start off a carpet cleaning business, and just because they're good at cleaning carpets doesn't necessarily mean they're a good business owner, a different skill set. But often they'll essentially create a business that is them or very dependent on them. That's going to hurt the valuation. That's going to decrease the market multiple because the business is them. They've, in kind of valuation terms, there's so much personal goodwill that's built up, and personal goodwill is not transferable. And so that becomes a challenge. You build a business that's not overly dependent, you're going to get a higher multiple, which in turn means a higher valuation. Reoccurring revenue is an important one. Buyers love some type of stability on a business revenue, if it's contractual or even if it's just habitual, that it's coming in rather than a one-time sale. Like I use the carpet cleaning business. How often do people get their carpets cleaned? Every couple of years, maybe. It's different than an eyelash salon, eyelash extension salon. I'm actually selling right now, and I'll tell you what, those ladies, they don't miss. They're every month, every other month.
And there's some good margins in there too.
There are,
right?
yeah. So there's a component of some reoccurring customer revenue that is helpful.
What about growth rate? Like you have businesses that are kind of plateaued and businesses that are growing 10, 15% a year, right?
Yeah, it's I'm glad you brought it up because it is relevant for why someone would buy a business. But from a valuation standpoint, especially when it comes to SBA and the underwriting, we're looking at historical performance. So that growth rate, as long as it's kind of trending and it's been captured over the last couple of years, increases the valuation. And some sellers hate to hear this, but I'll meet sellers and they're like, you know what, if I just put more time into it, someone could really grow it. Or if someone just put more money into it, they could really grow it. And they talk about this, potential. Well, people don't pay for potential. They buy for potential. But there's a difference between why you buy a business and what you pay for it. You pay for historical performance, at least from a valuation and an underwriting standpoint. Now, it would be a good broker would sell a buyer on why there is potential, but it doesn't really factor into at least valuation standpoint. We're not forecasting if only the seller put more time or effort into it, therefore the buyer should pay more out just because they have the opportunity to work harder than the seller. So it is important, but it's not necessarily directly impactful to the valuation.
Okay. So when we talk about valuation and the business selling price, how often is there a disconnect between the selling price and the valuation?
Well, it depends. The selling price when buyer and seller have agreed versus the asking price when we went to market. No, that's a good question. I never really tracked that. But ideally, there shouldn't be a large disconnect. And this is, part of my issue I had mentioned with business brokers. I had not been overly impressed by them. There are a lot of business brokers who may know how to sell a business, but they're not certified or credentialed to do valuations. And so and I don't know why they don't go and get more education and get credentialed. I mean, it's a core component of what they do. So it boggles my mind why there's not more business brokers that are getting certification and education. But the point I'm making is some of these guys misvalue the business so badly that they sit on the market and they don't sell. And then there is a big disparity between the asking price and what the actual, terms that the buyer and the seller can agree to. In theory, if I've done my job valuing it properly and I've based it on market multiples and I've done some SBA underwriting to make sure it fits debt service coverage ratios within the guidelines, I'm not valuing it so high that one, the SBA can't underwrite it and approve the loan, and two, I'm not putting a value so high that a buyer can't justify it from a fair market multiple standpoint. So those, in theory, should kind of counteract each other and be somewhat close to the asking price and the sales price.
So what are you seeing mostly, cash or SBA or some other sort of financing?
Hybrid between the two, yes.
Really?
I wish there were more cash deals. That makes life easier. Dealing with the SBA is long and cumbersome and challenging, and you want to pull your hair out, but it's the best option out there for buyers who don't have the cash, and most buyers don't have the cash. That's what the SBA program was for. You can get in with 5% down, ideally 10% down, let the SBA finance it. So most transactions are financed through the SBA.
Okay.
There might be some component of seller financing in there, 10 or 20%, but majority of it's with the SBA.
And with the SBA they're doing a lot with real estate too, right?
They do. You can also finance the real estate if the business owner owns the real estate. Most of them don't.
What do you like most and least about having SBA loans involved?
So obviously the thing I like most is it allows buyers to get in to buy a business that they couldn't otherwise.
Sure. Okay.
And let me just kind of touch on that. For it's becoming quite popular to buy an established profitable business rather than what used to be cool years ago, which was, the sexy startup.
Mm-hmm.
But it's so high risk. Why take that risk? Where if you look at like the business we were talking about before we started, this business has been around for 50 plus years, cash flow positive. I mean, how low of a risk can you get? And if you look at traditional SBA default rates over the years, it's very low. So buying a business that is cash flow positive, proven based on historical performance, is really not that risky versus a startup that is very risky. And we all hear the stats, how many of them fail. So I do like that. It allows business owners or buyers to get in that they couldn't otherwise. One of the challenges is you're dealing with a government agency, and that's just by nature slow and inefficient and cumbersome and challenging. And
it's usually like 3-4 months to get SBA start to finish.
If a buyer and seller, it's quite dependent on the buyer and seller.
Yeah.
First and foremost, how quick they can get all the documents, because they're going to ask you for a never-ending list of documents, and one document is going to lead to another and a question. Yep. So if you're fairly quick, you can do it in 60 to 75 days.
Oh, yeah. Okay. Yeah. So you probably see a lot of appetite, come and go. What are you seeing right now that you get a lot of demand for certain types of businesses, either selling or buying?
Yeah. I'll tell you exactly. I have a huge demand for, and it doesn't exist for the most part. These guys who follow social media, online gurus that are talking about buy a business for $0 down. It's absentee. Put a manager in place and let them run it while you sit on the beach and collect the payment. For the most part, no good business is handing it over to someone with no money down and say, I built this business for 30, 40 years. Why don't I just give it to you for nothing and just hope you pay me over time? I mean, really, think about it. Any reasonable business owner, why would they do that?
That would be a unicorn situation.
Unicorn.
Right?
Does it happen out there? Yeah, it does. but is it duplicatable and replicatable? And can you go out there and maybe you get lucky and do that once, but you're certainly not going to do that twice. And it's hard to build a strategy, an acquisition strategy around luck. Finding that needle in a haystack. And the reality is they shouldn't sell it for $0 down. Why would they when they have a good profitable business and they can go and get the SBA to finance 80, 90, 95% of that up front? That's what they should be doing. So at this point, I've done over 650 transactions. I've seen it happen one time where the seller agreed to sell it to the buyer. Finance the whole thing. And the only reason it happened is because the seller, well, let me rephrase that, because the buyer had worked for the seller for 20 years and was like a son to the seller.
Okay.
So finding someone walking out of the street. I'll tell you what does happen out there when people hear about some sort of 100% seller financing. They're usually buying a dumpster fire. They're buying a problem. Yeah. Maybe they don't know it's a problem, but they're traditionally buying a problem. The seller's so burned out and hates the business so bad, they're just going to get rid of it to anyone. And so that's a challenge. The other aspect to what you had asked about is the absentee ownership. That's becoming popular. And let's just kind of be practical about it. I think it's probably one of the dumbest ideas I've heard in a long time, because a lot of these guys are financing with the SBA, which means you're putting a personal guarantee on it. You're putting the house on collateral. And let's say you buy a business that's good, profitable, cash flowing business, SBA finances it, and you're going to put a manager in charge that makes $70,000, $80,000 a year and hope they run it. You're going to jeopardize your entire family's foundation, your house, your personal guarantee, your personal assets on some random manager that you don't know, you have no experience with. So I think that's a recipe for a disaster. It's happening out there because the SBA underwrites based on cash flow, and if they're buying a business and they're paying a fair price, you can get the SBA to finance it. I just think it's a huge mistake to expect to be absentee the day you buy it. Now, that's not to say you can't work your way out of the business in time, but that's different than saying, I'm going to buy this and be absentee from day one. The buyer needs to build relationships of trust with the customers, the vendors, the employees, learn the culture, learn how to operate the business well enough so that they can operate it remotely. A lot of these guys will buy businesses and they don't even know when there's the early warning signs because they don't know the business well enough. They didn't spend the 6 months to a year to really learn it well enough so that they could have just a sense that, hey, things aren't right. And by the time they find out that things aren't right, it's not a problem, it's an emergency.
So you mentioned the dumpster fire, the problems, and you just alluded to the due diligence phase of buying a business. What do people put enough attention into the due diligence, you think, or not enough?
Yeah, it's a really good question. And that probably depends on who their advisors are.
Yeah.
It's really dependent on, and it's part of why someone should be working with a business broker that's capable and competent and has the deal flow and the experience and the credential, the education. Anyone who buys a business with me, I send them to, I've got a couple of due diligence experts. And I'm not talking about their CPA that files their taxes that, will do whatever it is, 500 tax returns, and they're so busy you can hardly get a hold of them. And they really are just kind of a paper mill of filing tax returns. I'm talking about a CPA that actually specializes in due diligence. And for the most part, most of them aren't filing any taxes because that's not their line of work. They do due diligence. And so we were just barely talking. I was literally on the phone with buyer, seller, and the buyer CPA as we were going through a due diligence call and really kind of grilling them on the numbers to say, okay, the tax returns say this, bank statements, do they corroborate? Do they validate? Does the POS statement match? Do the sales tax returns match? And we're not expecting everything to match perfectly, but there should be some sort of a margin of error that's within reason. And if not, we need to ask some questions on it.
Fair enough. It seems like the due diligence would be worth its weight in gold if you're paying for somebody who specializes in that.
100%. I would not skip out on trying to save a few $1,000s, even if it's a bigger deal and you have to do what's called a quality of earnings report or a quality of earnings light report. And those can get pricey depending on the size of the deal and the complexity of how many transactions are there. You could spend tens of thousands. But if you're buying a business for $5 million and you need to spend $15,000 on a quality of earnings light report, it's probably the best money you could spend.
So on one hand, you have buyers that are going through and waiting due diligence, which is more of a mental and intellectual, like it seems smart to do. Mm-hmm. What about the emotional aspect? Do you see people just get emotional and get impatient and not want to do the due diligence?
Not want to do the due diligence, no, because I think most people are logical enough to know they need to do it. Now, does it take longer than they want? Are they asking more questions than they want? Do they get into more details than they want? So they might get frustrated in that. And it's not usually the buyers who are getting the frustrated. They know they're trying to protect themselves.
It's the sellers.
It's the sellers who are in business, but they aren't really great business owners, to be honest. There's a lot more bad business owners than there are bad businesses. And so sometimes the sellers, they're just not, they run their business based on their bank account balance. They have a little bit of money, things are going good, they can spend a little bit of money. They're not really tracking anything. And so they have such a low tolerance for detailed financial questions because they're not used to tracking it and doing it, and so they can sometimes get frustrated.
I know I've been a part of those discussions before where there's like this dance between the buyers and the sellers as far as, I think they're getting annoyed with the questions, or they're done answering questions, or, hey, I'm going to do this in writing, but.
Yeah. And the same thing goes for, there's a balance, and ideally, again, a broker should kind of be able to, walk that fence of that balance between the buyer and seller and say, okay, I'm sensing we're pushing this too far. We need to kind of wrap this up, or we need to move on to the next issue. The same thing goes for attorneys. Sometimes the attorneys can just go back and forth nitpicking the document, the language for so long that it can really burn out buyers and sellers.
So Trent, who are the most important parties on both sides? You mentioned, CPA, you mentioned attorney. We've talked about the business broker and evaluation expert. Like, is there any other roles that are important?
You need someone who's acting as closing agent, either an escrow company or an attorney that's drafting all the closing documents.
Yeah.
But yeah, for the most part, I mean, there's ancillary support that has to happen behind the scenes, making sure the buyer gets connected with the insurance contact, the HR, setting up payroll, merchant processing. I mean, there's all these other individuals that kind of need to be involved, but the core, for the most part, is what we talked about.
Okay. And what about, say you have a seller, because this has actually come up a couple of times, and they're saying, hey, do I have the right team in place between my current, tax advisor and my business attorney? Are they the ones to help me, go to the table with all of the the questions and negotiations? What would you, how would you answer that if
Very rarely does the seller already have the right team in place.
Good point. Okay.
Their CPA that filed their taxes for years is probably not the right guy. I mean, certainly he's not going to be doing the due diligence for the buyer. So he might be the right person to be in contact with the buyer's due diligence, but just because they are a CPA and they file their tax returns doesn't necessarily mean they have the right skill set or the time and availability to do that. And most of the time, the But the seller's attorney is not the right contact either, because attorney might have got them through business transactions and reviewing contracts, but unless they're a real transactional attorney that specializes in selling businesses, then they're probably not advising the client 15, 20 years ago when they're just kind of going through the day-to-day operations of the business. It'd be a different set of skills and experience. And that's the real challenge when sellers think I've got my guy, my brother-in-law who handled my divorce, 10 years ago, he's my guy. Well, he might be your guy, but not for this situation.
Yeah.
Yeah.
Do you see many conflicts of interests, in these transactions with professionals, like where there's a bias, or, maybe the attorney or the CPA doesn't want to lose, the business as a client, or
when you get the professionals that aren't skilled and outside of their lane, then we start, getting these, fights over things that shouldn't even be an issue. But you get with a good due diligence contact, a good business transaction attorney, they know where to pick their battles. The goal is to get the deal done, not die on a hill for some, silly clause in a contract that is going to block the deal from. Obviously, if it was relevant, that's different. But that's when we really get into, it's frustrating when, let's say, a buyer has a transactional representative on their side and the seller's using their, like I said, the brother-in-law who does bankruptcies. They're sometimes they can get in the way more than they help. Got it.
What about these folks that are buying and selling businesses that haven't been in that line of work before? Like, hey, I've worked in this line of work. I want to pivot, and I have a chunk of money.
Mm-hmm.
I want to buy a franchise. I want to be self-employed. Like, what are some observations you've made in these types of transactions over the years?
Yeah, it's a really good question. And in the lending world, there's something called transferable skill. That is becoming more important than ever, because in the last couple of years, SBA default rates are increasing. They're higher than they have been in a long time, because it is becoming more popular to buy a business. And there are more people that are buying businesses that are into industries that they have no background or experience, or they're trying to be semi-absentee or totally absentee, and the rates are defaulting. And the reality is, and I was just at a conference because I went through to get credentialed as an SBA underwriter, not because I underwrite any of my own deals. I want to better understand how SBA is going to underwrite my own deals so I can prep them and get them all ready to go to market.
Makes sense.
And the very first thing, one of the SBA underwriters on stage got up and said, the number one thing we're looking for right now, it's not down payment, it's not credit, it's background, transferable skill. So there's really kind of two components when an SBA is underwriting a deal. And a lot of times buyers don't realize this. They just look at the numbers and they think, oh, this looks good. This is profitable. This cash flows. And in the business buying world, that's called the buy box. Sometimes buyers will come up with this fancy buy box. Business has to be 10 years old, has to be 20% margins, has to have X number of employees, owner has to be retired. And so they've got this kind of wish list that they call a buy box. And they go out and find a business that matches that buy box, not realizing that they've totally missed the other half of the equation, which is the buyer box. In other words, as a buyer, do you have the background and do you have the skill to step in and run that business? That business might fit your buy box and it might be profitable, but I'll tell you, for example, I've got a surgical center for sale right now. It makes $1 million a year profit. And so I'll get these buyers who call me up, and I instantly know I'm dealing with someone that does not know what they're doing when they call me up and say, I'm industry agnostic. That's like code language for, I don't really know what I'm doing.
I'm an entrepreneur and I just want a business.
Yeah, they're like, I'll buy any business that makes money. No, that's not a good idea. That's actually a terrible idea because this, I'm making something up, HR director that saved up some money, is he a good fit for the surgical center? Absolutely not. The business is fantastic from a buy box standpoint, but there's no match between the buy box and the buyer box from a transferable skill standpoint. And so I think a lot of buyers have to think through that. And first off, don't call a broker and say you're industry agnostic. Tighten up your buyer box and say, look, based on my background, these are the 3 or 4 or 5 industries that I have interest in, that I'm competent in, I've got experience in. Because when a lender looks at the underwriting, they're going to check off the business historical performance and the financials, but then they're going to ask the question, why are you the right guy to operate this business?
Okay. So as far as selling businesses, what are the key things that make either a business sell quickly or like not sell at all or take forever?
Realistic price. That's
Okay.
first and foremost. Be, realistic on the price. Similar to what we talked about before, is the
Yeah.
business overly dependent on the seller?
Yep. Okay.
And it's not to say they can't sell their business, but they are selling a job. Someone might be, in business, but they're buying a job in that case. And you could still certainly sell those. You're just not going to get a price as high as maybe they would like because the business is so dependent on them. So pricing it right, having clean financials. No buyer's going to walk in and, just kind of trust, well, I got the POS statement, but I wasn't honest on my tax returns.
Yeah.
The natural question comes up is, look, if you're not going to be honest on your tax returns, then what else are you not being honest about?
Okay. Fair.
Yeah. From a buy side, it's a red flag.
Yeah. Well, so I think a lot of times people probably have a number in their head that they don't like. Same with people with their houses, like they don't want to go below a certain number, and they came up with that number for somehow, and they're sort of stuck on it. How have you dealt with that, or been able to get people off of a number onto a more realistic pattern?
It's a really good question. When I first started, I would kind of run through the financials of a business, even if it were just kind of mentally, as I'm talking with them, look at it. And I generally, at this point, have sold so many businesses in so many industries, I can give them a fairly, off the top of my head, a fairly general range of a multiple. And in my mind, we might be talking, and I would say, okay, I think we could probably sell your business for $750,000. And right out of the gate, they would be like, "Oh no, my business is worth $1.5 million." And it was this kind of battle between my opinion, just throwing out 750, and their opinion of what they wanted, 1.5 million. And years ago, I learned if I give them general education, which I've done through pre-recorded videos before I meet them, so that they understand that we're basing everything off the tax returns. I don't care about the unreported cash they have. I don't care about what their POS statement says. I'm looking on the tax returns because that's what any SBA underwriter, that's what a buyer is going to look at. That's the foundation. And then I educate them on what adjustments can be made. We can add back owner's wages. We can add back interest. We can add back depreciation, what's called add backs, to calculate what is seller's discretionary earnings and how it's calculated. And then in the video, before I meet with them, I'm showing them how I pull market comps. I'm not just making up a 3x multiple. I'm actually looking it up based on their industry, based on their size, based on the demographics of their business. We're looking it up, and if the market multiple is 3.2 and their tax returns show X in profit, $100,000, then we're looking at this and saying 3.2 times $100,000, that's your valuation. And it's now a logical math problem. And it's no longer like my opinion versus theirs. It's okay, this is how valuations work. These are the actual numbers. I might not like it, but I can't argue with the accuracy of it. And so what happens is they either say, okay, well, I'm burned out, or I have a health issue, or I'm ready to retire. We'll sell it for what we can. Or we look at where they're at now, and if they come back and tell me, okay, if it's worth 750, but they want a 1.5, great. Now you know how valuations work. Instead of taking the net profit times the market multiple, let's do backwards math. Let's take your ideal sales price divided by the market multiple, and that tells us how much you need to show in seller's discretionary earnings. So now they're walking away thinking, okay, right now I'm showing $500,000 profit, use a 3 times multiple, or let's say they're showing $200,000 profit and use a 3 time multiple, but they want 1.5 million. Well, if we do some backwards math, 1.5 million divided by the market multiple of 3 is $500,000 in SDE. There's now a gap. They were at $200,000. They need to be at $500,000. They can see, okay, you know what? I got to keep this thing and I got to grow it. And I got to go from $200,000 to $500,000 profit to justify the asking price that I want. And they at least now have a roadmap of where they need to go. Now it's up to them. Can they grow the business to that point? Is the business even scalable? Do they have the capacity? Do they have the time to do it? And some people do. And then they come back years later and they're like, okay, I'm ready to sell it. I'm where you told me to be.
So the multiple range, we talk about this multiple, right? So what are some of the ranges that you see for a given business, like on the multiple?
Depends on the industry. Every industry is unique and different.
So, for instance, if it was a software business, you might see that those multiples are coming down lately.
Yeah, but they're going to be higher than pizzeria.
Sure. But the range could be wildly different depending on, like you mentioned, the dependence on the owner.
Yeah,
for instance.
And their technology and how what sort of market share they have, and do they have contractual reoccurring revenue? Do they have a bunch of unique technology that no one else can really? Yeah, so the ranges are going to be wildly different.
Yep. The top 2 things that affect that multiple range, what would you say that those are?
Well, total revenue, as net profit goes up, so does the multiple, right? We're not comparing a SaaS company that has $1 million of EBITDA per year to one that makes $50,000 per year. They might be in the same industry, but that's going to be a totally different market multiple based on the size.
Okay, so the size makes a big difference.
Yeah, size also makes a big difference to who the buyer is.
Sure.
You get to up above $1 million EBITDA or more, you're looking now at family offices, private equity groups, versus something much lower that's an individual SBA buyer.
Okay. So if you have, what kind of businesses have the highest multiples?
I've never really checked, at least not recently off the top of my head, but software as a service is definitely going to be up there.
Okay.
Yeah.
And talking about technology, have you seen AI play a role in valuations and multiples yet?
Depends on what you're asking. I use AI all the time for how I'm doing it, but if you're asking if AI is impacting the business owner, it depends on the industry, if they can use it. But just because they're using AI doesn't mean they have a higher valuation. If they're using AI the way they should be, their cost should be going down, their efficiency goes up, profitability goes up, and that in turn affects the valuation.
Okay. Who should never buy a business?
Someone who has no money, just because they can get in a business. That is an interesting question. Obviously, if someone's wanting to buy a business, as long as they can have some type of skill and they buy a business within an industry they know, and they can save up a down payment or they can partner with someone, which, by the way, I don't mean to say you have to be the one that saves up the down payment. You could, in theory, buy a business with zero down if you have an equity partner that puts up the money as equity, not as debt. You can't borrow your 10% from someone else and then have SBA finance it and essentially be at 100% leverage. It has to be an actual partner that's putting up equity. So as long as someone has the desire and the skill set to work hard, I think owning a business is way better than working for someone else.
Sure. Yeah.
Yeah.
Okay.
I'm a big fan of anyone who has the desire to buy a business. Just buy the right industry and buy the right size. And maybe that's not to say you can't buy a smaller business and grow it and increase your skill set and then sell it at a higher price down the road, and buy another business and take a step up and get a bigger one.
Yeah. Okay. What about serial, entrepreneurs, people that own multiple businesses?
Yeah.
When should they stop or should they keep going?
That's totally personal preference. I would have no opinion on that.
No?
If they're able to successfully operate multiple businesses, then and they have the desire, then why stop?
Okay.
Yeah, absolutely. There's a couple of guys, in fact, here in town that own dozens and dozens of companies. And I'll tell you the model that's working for them. It's not so much what business they're buying, it's what operator are they putting in place before. So there's one guy in particular I know, I don't know how many businesses he's got, 30 or 40 that I'm aware of. And I'll tell you his model. Before he goes and buys a business, he first identifies the operator. And then once he knows he's got someone that he can trust, and usually what he does is he finds someone in their kind of 25 to 35 range, he's got some background and college education, manager in some other business, so they're in some type of a kind of a leadership role, managing people, managing organizations. And let's say they're making whatever, $100,000 a year. He'll go to them and say, look, I will buy the business. I will give you $120,000 a year salary, and then you'll have quarterly profit share with me. You're the operator. I'm the owner. And based on the operations, he'll give them quarterly profit. And that's all he does at this point, is he just goes from manager to manager in the quarterly meetings and just helps them from an advisor standpoint. But he owns all these businesses. The key is he's not trying to manage them all himself.
He's leveraging his time and giving the right incentives to incentivize the...
And he has the right operator.
Yep.
That's key if that model is the serial kind of entrepreneur that wants to make that work. You've got to have a jockey that's riding the horse. You can't ride multiple horses at the same time very well. Yeah.
Yeah. I'm sure there comes a point where if they're trying to operate more than one business, then they get over their skis, right?
Yeah. I mean, unless you're Elon Musk and these other skill sets that can really do it, most people can't do it very well more than 2 or 3 businesses, and even that might be a stretch.
Yeah. You mentioned, things that buyers do right to make it work. What about selling? I know, there's a lot involved with preparing to sell a business. What are some of the mistakes that sellers make or could avoid with some preparation?
Cleaning up the financials, like we talked about. I mean, that's just foundational, is to really get a grip on their financials, not just their annual profit, but just the day-to-day operations. They've got to speak accounting language. It doesn't mean I don't mean to say they need to be an accountant. They don't need to do their own books. But they've got to understand it enough where if someone comes in and asks for cash versus accrual and why there's a difference, and AR aging reports, they've got to have a handle on some of this stuff.
So they need to be able to understand it and be able to speak to it. When you said clean up, is there any other sense of the, use of that you mean?
Get all the revenue reported.
Okay. Yeah.
This is primarily a smaller business issue. Most bigger businesses report, but small businesses where the owner's there kind of day to day and they're, and I just give you an example. I was dealing with a restaurant yesterday, and the owner and his wife both work in it, and they're using the business as a giant piggy bank. They report what they want to report on the tax returns. They run all sorts of personal expenses through the business. When it comes time for their valuation, and I look at their tax returns, and I'm like, you guys killed you guys killed the valuation when you underreported to the IRS. And you thought you were kind of being smart by saving money, but if you're going to cheat the IRS on the taxes, you can't get the valuation for it. So you either pay more taxes and get a higher valuation, or you got to deal with the lower valuation. And just to kind of walk you through the numbers for that, because it might be relevant for buyers if they want to just kind of logically think through that. Let's just kind of make up some numbers here. Let's say a business underreports by $100,000 on their tax returns. Let's say they're at a 20% tax rate. So they saved themselves $20,000 in taxes. So they think they're smart, and totally separate issue whether that's honest and ethical and moral, but but they saved themselves $20,000. But now that you know how valuations work, and we're looking at a market multiple. Let's say that business was a 3 market multiple. What did that cost them in valuation? It cost them $300,000.
Yep.
So they saved $20,000 in taxes, but they got killed by $300,000 in valuation. It makes no sense to underreport to the IRS. Not to mention it's not honest.
Especially as they're, if they have a couple of years to prepare to sell a business, then ramp that up, right?
Yeah. So at
That's
least
a great example.
At least be honest in the last 3 years.
Yeah. So making sure, and the financials are correct in order. They understand them, and then kind of going back.
Try and work themselves out of the business.
Yeah.
What happens if they take off without any warning for 3 or 4 weeks? What breaks in the business? Do supplies get ordered? Does payroll still get made? Does services still go on? I mean, that's where they got to really start to think through where are they the bottleneck in their business.
So let's say a business multiple range is from 3 to 10, right? Mm-hmm. If the business is dependent upon the owner, which end of the multiple is
the
that?
Lower end for sure. Yeah. I mean, no one's paying 8 times earnings to buy themselves a job.
Yeah. And how often are you seeing the owners contractually needing to stay a part of the business for a period of time?
Not very often, mostly because the SBA won't allow it.
Oh.
SBA puts a limit. You can't stay on. The owner can't stay on as a key employee for more than 1 year.
Okay.
Yeah.
I'm glad you brought that up.
Yeah, and that goes back to partly the transferable skill. If the buyer has the right background, there's probably no reason for the owner to stay on longer than that anyway.
Yeah. Okay. So maybe it's just some interesting thing. Like, what are some of the biggest type of transactions you've been involved with, and how about some of the smaller ones?
There's no limit. We don't have any limit, high or low. We do have we do limit our fees. So as long as someone's okay with our fee, I've sold some small businesses, very small businesses, where sometimes my fee is greater than what they're netting, and they're as happy as can be because they're selling for some other reason than needing money. I'll give you an example. We had one where the seller was not in good health at all, but had 8 years left on their lease, and the landlord was not going to let him out. They were going to hold him accountable for it, and so they didn't care about, it was a small business and it wasn't worth very much. Otherwise we would have tried to sell it for more. So there was very little value there to begin with, but there was a huge amount of liability that they had signed up for. We sold it for a very low amount, and they were as happy as can be because when we sold it, we negotiated a assignment of the lease and it dropped them off of as being liable for the lease. And so that was their benefit to selling it. And then on the flip side, we've sold businesses. I think last year I did one for 19 million.
It's a good size one.
Yeah.
Okay. Yeah. And what types of, I mean, I'm curious, what types of clients will you, do you have like a vetting process of the clients that you'll work with and not?
Yeah, as long as they're realistic on the valuation and not jerks to work with, because we're going to be working fairly closely with them for a long time. They've got to be able to allow us to advise them through the process. And so I'm not looking for someone that, knows it all or is difficult or, challenging to work with, or, sometimes I've come across people that are sometimes just mean.
Yeah.
Like, you know what? I've got enough going on. I don't need to deal with someone like that.
Yeah. What's been the most exciting transaction you've been involved with? That I should say, most memorable.
Here's a memorable one. I'll give you the quick version, without sharing too much about the business because it's here in town, and really fantastic business. They made at the time about if I remember, $1.4 million profit. We had a buyer in place. SBA approved them weeks away from closing the transaction for $5 million. Seller calls me. Granted, we're literally weeks away from closing. Every due diligence is done, bank approval is done, escrow's drafting the closing documents. Buyer has quit his job and is ready to take over. Seller calls me and says, "You know what? Let's cancel the deal. I think I can grow this thing." I've heard that a million times. But I think I can grow this thing, and in a year or two, we can sell it for double, I think. He's like, and I'm like, no, we're under contract. You can't walk away.
Yeah.
Besides, that's just not right. We're not playing that game. And he's like, no, I'm backing out. I'm not selling it. And long story short, he had to, compensate us for our time. He had to pay the buyer for backing out the last minute. And we had to actually go to arbitration over this because it turned out to be such a mess, a legal mess. And at the end of the arbitration, I kind of thought, this guy is probably hates me. I'm never going to hear from him again. Because I told him, you're not backing out. It's just not right. And besides, you can't contractually back out anyway. And at the end of the arbitration, I told the arbitrator to go over, in the room, because we were in different rooms, and just let him know if he does sell it in the future, he needs to call me. And I didn't think much of it. I'm like, I'm never going to hear from him. He hates me. Well, a couple of years go by, and I get a call from this guy, and he's just as happy as can be, like friendly, not he's just treated as if it was no big deal. I think it was just in my mind, I thought it was personal. And in his mind, it was just a pure business transaction. As friendly as can be, invited me to come back over. He's like, remember I told you we were going to grow the business? And I was like, yeah. And I knew what was coming. I'm like, I've heard this a million times. You think you're going to grow it. You didn't grow it. And we're right back at the same valuation or worse. And he's like, well, I didn't double it. I quadrupled it.
Oh, my goodness.
And I'm ready for you to sell it for $20 million. It's like, are you ready? I'm like, well, that was not what I was expecting.
Wow.
And
did it go through?
That was the one I told you about for 19 million.
Okay. Wow, that is an interesting story.
Yeah.
One thing I wanted to bring up is being part of the exit planning world, there's a lot of high statistics around involuntary business exits, divorce, health issues, and so on. What have you noticed about these involuntary business exits as far as when they actually want to sell the business and it's kind of a fire sale?
I see it all the time. Yeah.
Tell me more.
Yeah. I don't track it like, there's some of these groups that probably track it. I don't track like how many of my deals, but I mean, 30 to 50% of my deals are probably a decent little business and someone's sick, whether it's them, mom on the East Coast, they got to take care of their wife, something comes up, divorce. I literally just last week sold a business for $2.3 million due to a divorce.
Oh.
Yeah, guy had multiple businesses. He had the right skill set. He could actually do that and run multiple businesses. This one business we sold off, literally the whole thing went to just kind of pay off his portion of the divorce.
Wow. Yeah, that's and do you ever have buyers that are like looking for these opportunities?
No, not really.
Okay.
Most of them aren't being priced as giveaway fire sales.
Okay.
And so it's not like I have a, secret list of buyers that are like, show up, because the reality is it goes back to the right location and the right background, and so even if I did have a list of buyers that wanted some fire sale price, they likely aren't the right background or the fit based on the industry.
Okay. Well, just as we kind of get wrapped up here, $1 million mistakes to avoid, like on either end, buying or selling. What would you kind of say are the standout mistakes to avoid?
On the buy side, overpaying, making sure you've got good representation to help you do due diligence, help you validate the offer. There are we talked about this, a lot of bad business brokers out there that are just putting together really sloppy what's called a SIM or a pitch deck. And they're adding back all sorts of expenses that they can't validate or rough numbers, or they're not following generally accepted valuation standards. They're adding back, sometimes there's a husband and wife that work in the business and they're both paying themselves $100,000 salary and the broker adds both of them back. And that's an issue. The buyer can't replace both of them. He can replace one person, then he has to go higher at fair market value, someone to replace the spouse. And so that's just kind of one example of how the listing side broker can do some really sloppy valuation work. And that 3 multiple, they added back an extra $100,000. That increased the valuation by $300,000. And the buyer, if they don't have the someone on their team guiding them to catch that, they instantly overpaid by $300,000. And that's just kind of one example of what to do. So being careful not to overpay and not having the right team in place would make a big difference. Same goes on the sell side, having the right team in place to value the business properly. Not undervalue it, but not overvalue it so it sits on the market for 2 years either.
Okay.
Yeah.
Well, there's a lot of emphasis on the right business valuation on both sides, it sounds like.
Yeah. A good fair business valuation should generally work for the bank, and a good broker should be setting that expectation to begin with.
When should someone reach out to you if they're thinking of selling? Like, how close should they be?
A year to 2 years.
Okay.
Yeah. I usually, a decent sized business is going to take probably about a year to get through, from starting the engagement, valuing it, taking it to market, getting a buyer through due diligence, finalizing through contingencies, SBA financing. It could take up to a year. So if they are thinking about wanting to sell, for example, in 2027, we should already be talking.
Yep.
Yeah.
Trent, you're a wealth of knowledge.
Yeah, it
Thanks
was
for
fun.
taking the time to sit with me for an hour and go through business, exits and buying and mistakes to avoid. Super helpful. I appreciate you taking
Yeah.
the time.
Thanks for having me.
Yeah.